topic on taxation and disclosure under the Esop, which will be taken by our own speaker Chintan. I request our past convener Jaykantbhai to briefly introduce.
Thank you very much, Jaykantbhai, for giving me this opportunity to introduce Sri Chintan Ghelani, our own member, friend, and the good cricketer. We have been playing cricket since last 10 years in BCSC together. So it's my pleasure to introduce him. Chintan Ghelani has post-qualification experience of around 17 plus years. His areas of expertise include tax advisory, litigations, tax compliance, and tax structuring. Chintan has also worked on various audit assignments over the years. He has built a dedicated team for gamut of direct tax services. He is also a member of Chamber of Tax Consultants as a convener of Representation Committee, Bombay Chartered Accountants Society, Borivali Study Circle, and is an enthusiastic in imparting training and also acted as a group leader in RRC organized by CTC. With this brief introduction, I request Jaykantbhai to present a memento to Chintan. I also request Bijal to contribution to CABF on behalf of BCSC. With this, now I request Sri Chintan Ghelani to take over the chair.
Request all the members who are sitting behind to please come forward.
Hello. Good afternoon all. So first of all, I would like to thank you, past convener Jaykantbhai, Vijay, all the committee members of Borivali Study Circle. I have been associated with Study Circle for the last 15 years, and I'll tell you, this is a very special moment for me to standing this side of the dais. Some of you would be knowing me for my cricketing skills and some difficult situation handled by me reasonably well in cricket, and hopefully today this topic, not very easy, difficult for me at least, I'll be able to handle very well. So thank you once again. Now, when I was preparing for this seminar, a thought came in my mind that when we say study circle, what is meant by study circle? Study circle normally means when enthusiastic members come together for sharing their knowledge, ideas and issues and discuss and deliberate on various issues. So in a way, study circle is always for learning and sharing knowledge. I have treated this opportunity in the same way, and hopefully I'll be able to learn more with all of you and make less mistakes, because when we study together, mistakes are bound to happen. With this disclaimer, I'll come to my topic for today, which is taxation and disclosures related to ESOPs. So why this topic now? So when Pratik Maru called me, voice is okay? Yeah. I'm audible? Yeah. So when Pratik Maru called me for this topic, that since July, it was before the due date was extended, so 31st July was nearing, and for return filing season, for many of chartered accountants like us who is practicing, for many individuals, it is very important topic, because nowadays many employees of MNCs are getting ESOPs in India as well as from the companies outside India. So this topic is very relevant for today's time and age, because more and more employees are getting exposed to foreign assets, ESOPs, and the disclosure requirements are very complicated and the penalties are very harsh. So this topic is very relevant for today. Now I'll start with my presentation. So as I told, today's topic is taxation and disclosure of ESOPs. I have kept objective is to, after this session, we all of us should have reasonable knowledge of taxation of ESOP in the hands of employees as well as company perspective, disclosure related to ESOPs, more specifically for foreign ESOPs, and accounting part a little bit. I am not expert in accounting, and some controversies related to ESOPs where cross-border ESOPs are involved. So with that objective I have set. My coverage would be some basic concepts, regulatory framework, different scenarios where ESOPs are involved, accounting perspective, employees perspective, and some controversies. Now, though all of you would be knowing why ESOPs or what is ESOPs, just for the setting a context, I'll just briefly touch upon what is ESOP. So mainly ESOP is a scheme formulated by company for retaining employees and motivating employees for long-term period, and the company gives right and not the obligation to the employees to exercise for subscribing to the shares of the company at future date. That is a basic what is ESOP is. Why company do it? So various companies would be having different objectives out of this scheme. Some of the cash-rich companies who are listed companies would be formulating this ESOPs plan because they perceive that in future the market value of their companies or quoted price will go up and employees will be benefit, and at the same time company would not be immediately required to pay something in cash. Secondly, nowadays startup, in today's world startups are the trend. For startups, cash is always in scarcity. So startups are more and more encouraging employees with this ESOPs plan, including their CEOs, promoters or the founders, whereby large number of shares are given to them by way of ESOPs based on certain terms and conditions, because at the time when startup is just inception or startup is building their business, at that time they don't have cash and they don't know the future valuations. But they do this scheme so that employees and the founders align their objectives with the long-term objectives of the company, and they all work together for building value for the company. So startups, companies, various companies implement this scheme for various objectives, and they keep various terms and conditions for ESOPs so that to achieve their individual objectives. Now, before going to the taxation part of the ESOPs, I'll take you through some basic terms related to ESOPs. All these terms looks easy, but before this seminar, even I was confused with lot of terms and overlapping of some terms. I was not clear about this term. So these terms are important from employee's perspective as well as employer's perspective. So what is grant date? Grant date is the first date where scheme is formulated and employees are given rights to subscribe shares. So shares are not granted, rights are just employee eligibility is decided and number of shares are decided. That is the grant date. Then company keeps vesting period ranging from 1 year. As per Companies Act, minimum 1 year is required, but companies can keep more than 1 year, 5 years as per their scheme. So vesting period is a time period wherein either the time has to be lapsed or some conditions which are prescribed under the scheme has to be fulfilled for options to be granted to the employees. Vesting condition, as I said, sometimes it is performance based, time based, or some other criteria are kept as a condition for vesting the options in the hands of employees. Once the vesting period is over, the date is, we can call it as a vesting date. Next is exercise period. After vesting, it is not necessary that employee has to exercise on same day. Company gives them a time period ranging from 1 month to 1 year, because company can perceive their future growth potentials and increase in their market value, and they give opportunity to employees for exercising the options. From employee perspective, it would be important. I'll give you one example. Suppose exercise period is 3 to 4 years, and some employees are perceiving that in 3 to 4 years, company's value will go up by 5 times. In first year it is 2 times, in third year it is 4 times, in fifth year it is 5 times. So in that case, it would be advisable for employee to exercise their option in first year itself, where market value will be lower, perquisite will be taxed at lower amount. So perquisite tax is a full tax rate at slab rate, and later on, when really the company's value is really high, they can sell these shares and pay less tax and long-term capital gain at 12.5%. So exercise period is very important for employees to decide about taxability aspects. Sometimes employees don't have cash flows to pay taxes on that perquisite value, so they defer the exercise of the shares. Exercise price is a price which is paid by employees to their employer in lieu of employer granting the shares or allotting the shares. Mostly when this exercise price is decided on the day one, on the date of grant. So at the date of grant, exercise price is how it is determined. Mostly it is kept the FMV, what is fair market value of those shares at that point in time, that is normally kept as the exercise price. Exercise date. Exercise date is very important from employee perspective, because under the Income Tax Act in India, that is the date on which taxation triggers in the hands of employee as a perquisite. So exercise date has relevance. Lock-in period after exercise, sometimes lock-in period is kept by companies for monitoring the shares availability in the market, etc. So lock-in period is not compulsory, but companies keep this as per their requirement and to achieve their objectives. Exit event. Really, till now, employee has just earned notionally. They have earned something, but it is notional, it is not cash. So when they sell the shares actually in market, outside market, or to some investors, at that point in time, they will receive the cash and capital gain will arise. So this is basic term related to ESOPs. Now, I'll take you through some of the variations which are right now going on in India and outside India. So first, as I told you, ESOP, plain vanilla, and what are all the terms I have discussed will cover ESOPs, so I am not going into that. Second is employee share purchase scheme, not very relevant in India. In US, it is adopted mostly. Esop is doing this, where employees are given option to purchase shares from open market at discounted rate. So in this case, the good thing is there is no vesting period at all. Directly employee exercise the options and they get the shares at discounted rate from the market. So the taxability will be the same, but there is no vesting period or vesting conditions or grant date. It is direct purchase from the market. Next is stock appreciation right. So this is also more prevalent in US, and now India is also, many companies in India also is implementing this. Stock appreciation right, alternatively called as phantom equity plan, is a scheme where mostly shares are not issued. Instead, some notional units are decided and formulated by companies, and based on the fair value equation of that units, ultimately employees are paid cash salary. So this is where no shares are issued most of the cases. So therefore it is called stock appreciation rights. Sometimes it is also settled by issuing equity. So treatment will be same as the ESOPs. Restricted stock units. So this is also more famous in US, where mostly the difference is that employee doesn't have to pay anything. these units are allotted to employees without any payment. So you can say in a free. Taxability will more or less same with ESOPs, but mostly lock-in period are kept because these are listed shares, and to manage the flows of shares in the market, some conditions are kept. Sweat equity shares are shares which are given to promoters or some important employees or directors for them giving the know-how or intellectual property rights or some valuable inputs to the company. So these sweat equity shares are mostly issued without cash, without consideration, and issued to mostly director employees at the initial stage of the company. Now, regulatory framework. So, as we all know that ESOPs are only issued by companies. So, Companies Act would be involved first of all. Apart from normal Companies Act provisions related to passing of special resolutions and convening meeting, etc., the important rule is Rule 12 of the Company's Share Capital and Debenture Rules, which outlines all the terms and conditions, minimum terms and conditions which are to be followed for any particular scheme, and all the companies where SEBI regulations are not applicable have to compulsorily comply with all these conditions prescribed under Rule 12. Income Tax Act, of course, has to be complied with. Wherever cross-border ESOPs are involved, FEMA would come into picture. In case of listed companies, the regulations prescribed by SEBI would be important. In terms of accounting, the accounting standard will come into picture, accounting policies will have to be framed, and for various ESOP scheme valuations would be required to be obtained. Now let us take very simple example that how the taxation will work. So as we understand the terms, first is a grant date, then there will be vesting period, then next step is the shares are vested to the employees, then there is exercise period, and the date on which employee exercise, that is the taxable event in the hands of employee. So fair market value on the date of exercise less whatever exercise price paid by the employees would be considered as perquisite as per section 17(2)(6) of the Income Tax Act. The FMV on the date of exercise will be decided if it is a listed stock, then higher value and lowest value quoted in the recognized stock exchange. The average of the two values will be considered. In case of unlisted shares, a report of merchant banker would be required. So after exercise, whenever employee sells their shares in the open market, so based on the holding period, long-term or short-term capital gain would be decided, and the capital gain would be sale price less FMB, which is already taxed in the hands of the employees. Similar to this treatment, for all other treatment will be more or less similar. In case of employee stock purchase scheme, since there is no vesting period or no exercise period, directly shares are purchased, so whatever discount is given to the employees, that will become perquisite and it will be taxable under the same section 17(2)(6). In case of stock appreciation right, when money is given based on certain formula and mechanism, it is directly taxable as salary because it is cash and not something in lieu of cash. So it will be normal salary, taxable whenever it is paid. When stock appreciation rights are settled through equity, the treatment will be same as ESOPs. Sweat equity shares treatment will be the same. In case of startup, just to note here a very important aspect. In case of startup, some leverage or leeway has been given under the Act because the government recognizes that startup there is liquidity issue for company as well as employees. So where startup, eligible startup who are registered or who has got certificate from DPIIT and interministerial panel under ATIC, those startup where they formulate a scheme and grants ESOPs, So for those employees, the taxation will trigger when either they will sell the shares or they'll resign from the company, or 5 years from the end of the financial year which the ESOPs are exercised. So taxation is deferred in the case of startups. So that is important point to be noted here. Now let us take an example. I'll take you through the basics of ESOPs. Hopefully now we'll be able to answer the basic taxation of ESOPs. So Mr. Nilesh was granted 1000 ESOPs in February 2023 when FMV of the share was 7600. Vesting period was 1 year and exercise price was 7500. In February 2024, shares got vested in Nilesh. In March 24, Nilesh exercised the options and paid 75 lakhs. That is 1000 shares into 7500 per share. And FMV on the date of exercise was 8000 per share. Later in May 2025, Nilesh sold those 1000 shares at 10,000 each. Now we have to find out the taxation part of it. Anybody would like to try, Pratik? What is taxation event and what would be the perquisite value?
Perquisite value will be the discount between fair market value and the offered price.
Yeah, which is?
8,000 minus 7,000.
Yeah, exactly. And at the time of sale,
8,000 minus.
yeah, sure. So everybody is attentive. After break, chai is working. Great. So this is simple taxation. Till now, I think no issues. Everybody knows this and have dealt with this. So no problem. And most of the time, employer in Form 16 deducts tax, and we have to just consider that Form 16. So we are not facing any problem till now. So great. Now let us move on to the some difficult aspect of ESOPs where cross-border transactions are involved, and which is main heart of this today's seminar, wherein foreign companies are issuing shares to the Indian employees. And Manuel, last year or day before last year, many of my friends or friends of friends have come to me for filing returns, wherein they were filing the returns, including CAs, filing returns without reporting this, because in ITR 1 there is no requirement for reporting any FA. But then for last 2 years in papers, newspaper and all social media, the things is going on that there is penalty, some penalty for non-disclosure foreign assets, so people have become little vigilant. So most of the small cities also, I have found that people are not complying with this requirement. But what is happening is that company employees are working in Indian company, but the parent company is out of India, and they are issuing listed shares to these employees outside India, and people are not knowing what is to be done. So that is very difficult thing to handle, because even CAs are missing this, who are filing the return on their own, and this requires lot of efforts for reporting purposes. So before starting the disclosure part, and from taxability perspective, let us quickly go through the important provisions in the Act which will be dealing with such transaction. So this section 5 normally we learn when we start taxation in our articleship or classes when we join CAs. Scope of total income for resident, any income received or deemed to received in India, or any income accrue or arise in India or deemed to accrue or arise in India, or for resident even any income accrued outside India is also taxable. This is basic concept. But mind well, later on when I'll take you to some difficult controversies, these all principles will be tested. For non-resident, any income received or deemed to be received in India, or any income which is accrued or deemed to accrue in India. So very standard things we have learned so many times. Section 9, which deals with income deemed accrue or arise in India. Specifically, section 9(1) subclause 2 deals with salary taxation, which says income which falls under the head salaries and income which is earned in India. So salary which is earned in India is said to be income deemed to accrue or arise in India. And below that section, explanation says that income payable for services rendered in India is to be termed as income earned in India. So it's very clear, income earned in India means whatever is earned for rendering services in India. Section 15 of salary chapter is charging section, which says any salary received from employee, employer or former employee, whether due or not. And subclause 2 says salary paid or allowed by employer or on behalf of employer. I am putting emphasis on by employer or on behalf of employee, any salary paid or allowed. Section 17(2)(6) we already know, perquisite taxation. And wherever cross-border transactions will involve, so DTAA also will come into picture. Article 15-16, mostly different DTAs deal with the dependent personal service article, which deals with salary, etc. So with these basics, now what happens if an Indian employee of, say, Accenture Limited, who is working in Accenture India Private Limited in India, and they are getting shares of Accenture US, foreign listed shares. So whether it will be taxable? So first my argument would be why it should be taxable, because I am not getting that from my employer. Accenture US is not my employer. So why it should be taxable? There is no employer-employee relationship. So it is taxable as a what? Whether it is not from my employer. So whether it will be taxable.
Resident Indian global income is taxable.
Agreed, but whether it is a salary. For employment, India is getting salary from Indian employer. Additional salary, but my thing is that suppose your employer has arrangement that he is paying salary and some part of it will be paid by some other company where you are not employed. So whether you still offer that as a salary.
I am getting those shares because I am working in Accenture India.
Agreed. So, yeah. So what I was saying, those arguments are already made, but mostly rejected by various judicial pronouncements. So in case of Sumit Bhattacharya, the same very famous case, I think it was before when the perquisite taxation, right now what it is, the case is relating before that, when perquisite taxation was different. Though the SSC had mainly argued that Procter & Gamble Singapore had given him the Esops. He was working for Procter & Gamble India. So his main argument was that I am receiving from non-employer, so it should not be taxable as salary. Ultimately it was decided, what the sir said, that this is mostly in connection with the employment and therefore it should be taxable as salary. And the reliance was placed on this very famous judgment of Supreme Court in case of Justice Devaki Nandan Agrawal. Very interesting case. So in this case, Allahabad High Court judge Devaki Nandan for AY 78-79 filed his return without offering his salary. He took a stand that salary is not taxable. The matter went to Supreme Court after passing all these lower authorities. So his argument was that as per Article 125 and if I am not mistaken 165, which deals with salary of judges of High Court and Supreme Court. So basically judge of High Court and Supreme Court are not employee of anybody. They are directly working under the Constitution of India, and Parliament till 86 didn't have right to monitor that. So there was no employer as such. So we have taken a stand that this salary is not taxable because under the act, what I am getting is salary, but I am not receiving from employer, and therefore it should not be taxed. Ultimately, the matter was decided by Supreme Court. No, what he is getting is remuneration, and though there is no employer, but what he is getting is under the Constitution. So and therefore it should be taxable as salary, and therefore it was famous that the condition of receiving salary is now not sine qua non. It is not compulsory. So with that, now the matter is mostly rested that anything which you are getting in connection with employment is taxable as salary. There is one more judgment, advanced ruling on similar lines. So now essential employee, Indian employee has got the shares in US, and now what are the implications? Somebody has just come to you saying that I have got these shares, help me filing the return. It's very easy. You take 1,000, 2,000 fees, it's okay. Our fee standards are, very difficult one, because salary return nobody is ready to pay even 5,000. Now what would be the implication? Before taking the assignment, let us see what are the implications and what efforts will go into that. So first of all, perquisite will be taxable as 72(6), and in Form 16 and Form 12BA, it will be reported. So that to that extent, it will come through directly. How it will work? How it happens? So any person who is receiving salary, they normally get constant flow of salary, right? They don't want different up down in salary. Sometimes 1 lakh, sometimes 50,000. They will not do, because everybody plans their affairs in such a way that whatever his salary is received and mostly it is spent or invested. So suppose they are exercising rights of 50 lakhs shares and tax liability is 15 to 20 lakhs. They'll not be able to fund that because their 1 month, their 3-4 month salary will be able to then meet the obligation of taxes. So how it happens? So in US, when shares are allotted based on their scheme and whatever number of shares are allotted, they have some market value. So to the extent of tax liability which is to be met in India for perquisite taxation, to that extent they immediately sell the shares. There are some lock-in period kept in the scheme, but to this extent they exclude this lock-in period and they allow to sell those shares to meet their tax liability. So they make a mechanism whereby in foreign company shares are sold to the extent of tax liability. Mostly what happens, the day of sale, my exercise and date of sale is both same, so there is not much capital gain, though it will arise somewhat but not major. So on that date they will sell, popularly known as sell to cover. They will sell the shares, they will remit that proceed to India in the Indian company, and Indian company will pay then that tax to the treasury on the perquisite valuation or perquisite taxable perquisite. So employee will still get the normal constant salary whatever he is getting. So this works this way. But in the process, what all is happening, an Indian person is creating a demat account outside India. He is creating bank account, because demat account only shares will be held, but whatever proceeds cannot directly come from demat account to India. So some bank account has to be opened. So in bank account proceeds will move, then from that bank account it will move to India. So bank account will be opened. First there will be transaction of allotment of shares, then there will be sale of shares, then there will be capital gain on those shares. For whatever period you will keep, there will be dividend. You will also keep your saving account outside India, you will earn interest. So just imagine all these transactions are created with one few shares of Esops outside India. All these transactions are created outside India, and you all have to meet the obligations of foreign assets, income in the ITR. Acha, on interest or dividend, tax will be deducted outside India. So, and you have to pay tax separately in India. So you all might have to file Form 67 in India after considering proper taxes, whatever is paid outside India, and thereafter you have to claim credit under the ITR schedule TR, foreign tax credit, and sometimes we forget that. So government has relaxed that rule that you can file Form 67 till end of the financial year. So all these requirements are created. Now what is the headache? Headache is to convert foreign currency income into Indian currency. And lot of disclosure it is to be made in Indian currency, whereas the amounts available are in foreign currency. So Rule 115 will come into picture. For capital gain, interest and dividend, you have to apply TT buying rate of the month where income is earned, preceding month's last day. Whatever is TT buying rate, you have to apply to convert all those income into Indian currency and for offering those income. So just imagine somebody has come to you with filing of return that it's my salary return, I will just receive some ESOPs, there is nothing else. But all those requirements are created and you have to deal with it. That too, data will come, not come, however data, what the data would be, and whether it would be accurate and complete, you don't know. So after analyzing this, you can definitely take the assignment at appropriate fees. So first of all, for just example, before taking to ITR, this is kind of demat statement we get. I think it's not visible. So this is a brokerage about in India what we get. Similar to that, your holding is so. Once somebody says ESOPs are granted to them out of India, we have to think and ask them all of it. They will resist, they will not share. Sometimes who are not very familiar with us, they will doubt that whether we'll be doing properly or will misuse it or something. They don't want to disclose their foreign assets or not disclose their wealth. But we have to ask this is required. Now if we go to ITR, the first schedule which will be there would be schedule of unlisted shares. Mind well, whatever shares may be listed outside India, but for India it is unlisted. Because in India listed shares are considered only those which are recognized in Indian stock exchanges, not outside India. This schedule I have found in my office, many times we are making this mistake and not reporting here. Foreign shares we are not reporting, we forget to report here. So unlisted shares have to be reported, all the foreign shares. AL schedule, wherever income is exceeding 50 lakhs, you have to disclose under AL schedule, under shares and securities. Now most important foreign asset schedule. So first will come deposited account, where we report all our bank account, all basic requirement of name of the bank, address, PIN code, etc., account number, starting date. See, start date here is 1984. And the main shock will come to you when you try to report this, that you are reporting it the first time, but the person will give you this date 5, 6, 7, 8, 10 years back. So what will be about the all past years where compliance is not done? So you will feel little risk in this, but you have to tell your client that for all these past period, if anything comes, you have to bear it, because you cannot do anything. And this will be a shock. Whenever you report from new person's ITR, you will see that their date of inception will be way back and not the current year. Then the schedule A2, where we have to report demat account and various nature of income, dividend, interest, proceeds, bank account, start date, opening date, peak balance. A very difficult task. Nobody wants to share entire year statement. See, we don't want normally entire year statement, we want just transaction detail. But for peak balance, we will have to have full details. And now it is calendar year. For disclosure purpose, department has prescribed that you can follow calendar year. But for tax purpose, offering income, you have to follow financial year. But for tax purpose disclosure, you follow calendar year, because world over mostly it is calendar year. So to match with those details and inter-exchange of information with various countries, they have prescribed this. But for peak balance calculation, it is a task to get all the 12-month statement, because people will give 1 month statement, 2 month statement where transactions are there. People are not maintaining this, and they find it very cumbersome to ask their foreign advisor or their company all those details. So peak balance is an issue.
So
Closing.
it is a maximum balance, right?
Yeah,
For
maximum.
entire period.
Yeah, entire year. During entire year.
January for last year ka
January.
if it's a calendar year, you'll have to take last year's return.
Yeah, 2 years. 2 years data.
January to December.
Calendar year, we have to ask them for all calendar year. So there is an issue. And then you report the gross income here, whatever you earn, which you converted from foreign currency to Indian currency. But now question will come, here you will report income of calendar year or financial year. Because disclosures are for calendar year, but if you report in calendar year, and when in schedule you will report different, so amount will differ. So there is an issue there. In our office we are taking a stand, we are reporting financial year to match with the schedule, because from these details other schedule FSI of foreign source income is prepared. So to avoid any discrepancy there, we are reporting here the financial year income. Next is schedule A3, where you report all your equity shares or debt related instrument. Again, all the date of acquisitions, peak balance, closing balance, and whatever income is earned out of it, you have to report in this schedule. It is fairly clear, I think.
So how do you compute peak balance? Since I have suppose 100 shares of Essential.
Yeah.
So what do? You take out the share price of entire year
Yes.
where it is maximum and then report that.
Yes, we are doing that. From US stock exchanges.
So
Yeah.
1st January to 31st
Yeah.
December, whenever it was the highest. And
We are taking that US stock exchange data and all. Now it's
then you
available.
convert into Indian rupees. also.
Correct. So we take in dollars whatever is highest and then convert, rather than we comparing in Indian currency. Because then it will currency will be different, so then it will take an
Yeah,
issue.
amount can change.
Change. So we'll take in dollars and then we'll convert.
Sir, in case of we are considering financial year, then how TDS matching is income tax matching will be done for the foreign source of income?
See what will happen for December. This is happening practically. You can take TDS credit, foreign tax credit for financial year, which income you are offering, which will be financial year, and which will mismatch with your US filing. So there you have to proportionally take 9 months from that, and for second 3 months you have to consider whatever is still returns are not filed there, but based on whatever data is available, you have to take it, because in law that is the requirement, because you are offering income for April to March, so you cannot take credit otherwise. Practically, if you are taking consistently calendar year, for against 1 year you are taking credit 1 year, it's processing, it's okay, but if somebody will ask that question, then they will not be answered, because in law it is not prescribed, but consistently something you are doing, and if you are not taking any undue benefit, then it should be acceptable.
Reporting currency, the rate is going to be the closing rate for 31st December or 31st March?
31st December. Closing balance you have to take 31st December.
Sir, buying telegraphic freight,
Yes,
how we will get them paid?
SBI site we have to take. This is prescribed under the rule that you have to take SBI TT buying rate. SBI buys the rate that we have to consider, and on online it is available. The data is mostly available of SBI. That is prescribed rate, but as far as whatever rate you are taking is near to the actual rates, I think that should be okay.
Do we have to report unvested shares over here? I mean,
Yeah.
there are exercises that are unvested also. So does unvested shares also?
So unvested shares, in our view, is not any financial asset. It is just a right which is not in financial terms and not required to be reported. Unvested shares are not to be reported. This is the schedule FSI.
But we have a right then, I think so, if it is a foreign asset, it should be disclosed in some, not in shares.
So it is not an asset till now. It is something right you have got.
Right is intangible, something.
Yeah, intangible but not in money terms. There is definitely right. You may have so many rights in that way, but if it is not converted into financial terms and some conditions are kept, it is not unconditional right. On the vesting date, it is unconditional. Till that, it is conditional. So the arguments can be both sides, but more prevalent view and legal view is that not to be reported. And my controversy will come, we'll touch upon that. Next is schedule FSI, where all the income of foreign source incomes are reported, as well as whatever TDS we want to claim as foreign tax credit is also reported. Most of us who are using software might not be knowing this schedule because it is picked up automatically. So, but while preparing for this seminar, I came to know that no, this is also one of the schedule, because on software it is captured automatically. Schedule TR, as we discussed, we have to report at what rate foreign tax credit you are claiming. Of course, foreign tax credit will not be more than what is you are paying in India, though you might have paid more in foreign country, but in India you can claim to the extent of what tax you are paying, average rate of tax. Then you have to report their tax identification number in the foreign country, DTAA article which you are applying, section 90 or 91, we have DTAA section 90 if we don't have DTAA 91. So all those reporting along with the supporting, whatever supporting you have to attach for claiming foreign tax credit, you have to comply, report in ITR. First you should file form 67, then file this ITR for smooth processing of return by CPC. This is something form 1042S, more prevalent in US. No, it is US form only. So some kind of this form will come. If somebody has not seen this form, will ask what is that TDS certificate, sometimes like what is that, how it is, how it looks. It looks like this. You should get it from your employer or from banks from US, and then based on this TDS credit should be claimed. And sometimes what we have seen is people are making mistakes. Dividend or interest, they are taking directly from bank account, which is net of these taxes. However, the incomes are to be reported gross. Income is to be offered gross. And then TDS is related. Sometimes if articles are doing work and they are capturing details only from bank account and you have taken those numbers, but then TDS you are claiming, but you have not offered that in income. So that should be taken care of. Acha, what is the main part and our selling point? 10 lakhs penalty under Black Money Act for non-disclosure or inaccurate disclosure per year. So whoever is coming to you, you can tell him about so many requirements, so and so, but last Brahma says 10 lakhs penalty, Black Money Act for 1 year. Every year, if 5 years you have not made, you will be charged penalty for 5 years. 10 lakhs per year. And this is not only this. Whatever income is not offered for that or assets are not disclosed, on that there is separate taxation. I am talking about this penalty, but if income is not offered, on that 30% tax rate flat, and in asset which you have not disclosed, which is not out of some income which you have not offered, on that 30% tax plus 60% penalty. So apart from this 10 lakhs for not offering income, it is the whatever taxation is very harsh under Black Money Act. So whoever is coming to you with simple salary return with foreign Esops, you have to be very careful. and tell him about all these issues and requirements and charge very handsome fees.
Even Form 67 has to be filed.
Yes, that is one of the points. So I try to keep everything masala for anybody to pitch for the client or give them proposal. For July season is coming.
It is September.
As we told for ESOPs, in case of startups, the tax is deferred. So to capture, because how will government will keep a track of those ESOPs of startups? So in ITR, onerous requirement is there. I don't know who is filling up, but it has to be filled for government to capture the when it should be taxed and it is not missed. So now you see in ITR, they have done in certain way that all your acquisition of shares, either in unlisted shares or here, where the data is not publicly available from demat accounts, they have captured your data everywhere. So you cannot play with your acquisition or sale date anytime. Now with the ITR, all data is captured for all your shares and securities, at least shares. So you have to be very careful. And the earlier what was happening about backdated transaction of purchases of shares to book some loss or profit, I think we have to forget that now. So after completing transaction of foreign employer or foreign holding company issuing shares to Indian company, we move on to reverse transaction. It's not only that foreign companies are holding company and having presence in India, even Indian companies nowadays are having lot of foreign subsidiaries and doing very good businesses and setting up many subsidiaries outside India. So now if some clients come to you about that we have formed this scheme of ESOPs where we are providing ESOPs to many foreign employees of subsidiaries, etc. What is my tax requirement or obligation? If Indian employer is issuing shares outside India, in our case we were having all the jurisdiction that employer, those are Devaki Nandan judgment of Supreme Court, etc. was in Indian context. But for foreign, we don't know the foreign law. And right now we are in India, so what are the obligations? So as I told that companies share capital debenture rules deal with the ESOPs scheme, and all the companies have to follow those ESOP conditions under that rule. There it is specifically written that any employees, I am referring clause C, any employees of subsidiary in India or outside India or of a holding company. So even the employees of subsidiaries are covered, and therefore under the Companies Act all the employees would become employee of the company, and Indian company will become employer, and TDS requirement will trigger. But now question will come, whether that salary or ESOPs, which we will say ESOPs is a salary, so whether it will be taxable in India. So now we go back to our section 5, section 9, whether it is for salary earned in India or whether that income is accrued or arise in India, because all those employees would be non-resident. And for non-resident, any income received or deemed to be received in India or any income accrue or arise in India will be taxable. But in this case, employees are providing services or rendering services outside India. So the answer is that the accrual and arise is outside India, and therefore salary is not taxable in India. However, it also says any income received or deemed to be received in India. So in this case, demat account of those employees would be created in India. Indian company will issue shares in India. So in a way, income is received in India. So now what will happen? So a doubt is created, though we are saying it is not accrue or arise in India, but on receipt, at least it is there in India, and India has got some right to tax it in India. Some rights are created. So one can argue first that the income which is already accrue or arise in India and which is taxable, so it is taxable outside India in foreign country. So same income cannot be again taxed on the receipt of it. That can be the first line of argument. Second argument to the authorities can be protection from DTAA. So most of the DTAA, what they prescribe, Article 15 or 16 of Dependent Personal Services, that income will be taxed, salary income and the related income will be taxed in the country in which the person is residing or person is providing services, employment is exercised. So most of the DTAA has this protection. So since employee have render service outside India or exercise employment outside India, so under DTAA the right to tax will be only with the resident country and not the source country. Unless employees have spent more than 183 days in India, most of the DT says that if it is spent more than 183 days in the other country like in India, then the right will come to India. But in that case, he will become resident in India. So of course, salary will be taxable in India. So for our discussion, for Indian company issuing ESOPs outside India, will have to, if we are not okay with the first argument about that it is litigative, to argue that though it is received in India but it is not accrued in India. So to avoid that litigation, what company can do is they can apply DTAA, but for applying DTAA, the main requirement is to obtain TRC, Form 10F and no PA declaration. So these requirements, I don't know whether companies are following or practically not following, but this issue may come in future. Sometimes under TDS survey, department can take up this issue. So we can advise conservatively to our clients to maintain this documentation.
So these documents are maintained, then even no TDS also required to be deducted, right?
No, I am saying, yes, TDS is not required in both the arguments, TDS, because what will happen, nobody would like to deduct TDS in India of foreign employee, you have to then take pen of the employees of foreign companies and so many requirements will follow. There will not be double taxation because employee will take the credit, but there would be quite a lot of requirement and efforts would be required. After this, now if we go to employer taxation, so here though in employee's case grant date was not important, in case of employer grant date is also important. I have just kept here the what is law right now, but it has emerged after so many years in so many litigations. Earlier, department was taking a stand that ESOP expenses are not allowable expenses because those are contingent expenses. And all departments and tribunal ruling were that it is not allowable expenses. Then the matter was famously dealt by special bench of Bangalore Tribunal, wherein the principles were settled that ESOP is definitely an allowable expense because that is an obligation, present obligation for an employer to provide some benefit to the employee in future. And in that judgment, they have dealt with that on the date of grant, whatever is the fair market value, less the exercise price. To that extent, liability is crystallized. Only thing is that it will devolve during the vesting period. So, whatever is the difference between FMV on the date of grant and the exercise price should be amortized over a period of vesting. Suppose 4 years, to in 4 years. Not only this, one step further, what is happening in that taxation is that at the date of exercise when employee is exercising, their market value, say suppose on date of grant market value is 110 and on the date of exercise it is 310. So 200 rupees will be taxable as a perquisite. Sorry, 100 would be perquisite and FMV is 300. At the time of exercise is 10, so 300 would be taxable as perquisite on the date of exercise. So company has claimed 100 expenses, but on the date of exercise perquisite tax at 300. There is gap of 200, where employee is paying tax but nobody is claiming expenses. Because when we talked about grant, only 100 rupees is claimed. So tribunal has prescribed that the 200 rupees when employee exercise, so whatever was taken on grant date 110 and now the exercise at the time FMV is 310, so 200 rupees should be allowed to the assessee employer in the year of exercise over and above whatever is claimed till now. But this will not be there in accounting. For perquisite, there is no accounting entries. So, as a tax advisor, what we have to do is we have to ask for details of perquisite tax in the hands of employees. We have to check whatever is tax, and then we have to reduce whatever is already claimed. Because this amount, whatever is tax as perquisite, might also include something which we have already claimed on year-to-year basis based on the vesting. So that calculation has to be done very carefully, and additional claim has to be made every year in all those cases where ESOPs are exercised at much higher rate than the rate at which it is allotted on the grant date.
But accounting will be based on the
Black and short model.
black and short model, and
Yeah.
even the fair value at the time of whether grant or vesting, whatever. Right now, we have accounted it. Suppose now even the fair market value will be 300, but we will not change in the books.
Books will not change. So that's what, for this perquisite, there will not be accounting entry. Notional. So we have to make a separate claim in computation, any other deduction between 28 to 44, there we have to make this claim. Based on proper working, because we might have claimed part of it earlier also. So famous was the Biocon judgment, first by Bangalore Tribunal and then confirmed by Karnataka High Court, and then it was followed in many cases, Mahindra Bank for Mumbai and many other cases. So as I was discussed, let us see this example to clear the concepts. Borivali Centrally CP Limited, I wish there will be a company. So has granted 10,000 shares to 100 employees, each employee 100 options. FMV is 110, exercise price is 10, vesting period is 5 years. So and each of the year 20% is vested. See, all this is little complicated. Vesting I have kept for this example very simple. Otherwise in practice it is very difficult scenarios of vesting and there are so many complications. So I am not going into that. So if vesting is happening 20% consistently over the 5 years, so difference between 10 and 110 you will claim over the period of 5 years. So 100 will be claimed over 5 years, 20 each. Now in the 6th year, exercise period is 6 to 8 years. If FMV is 310, till now you have claimed 110. So the difference of 200 will have to be claimed in the year 6 when options are exercised. This will be a separate claim in computation which has to be worked out. This we had discussed. Accounting part, I'll just touch upon. More or less for Ind AS accounting, it is Ind AS 102 share-based payment and employee benefits, Ind AS 19. In non-Ind AS companies, it is AS 15 employee benefits. The difference between ESOP and stock appreciation rights which are settled through cash. The difference is that in case of whatever is settled through equity on the first year, amounts are debited in employee expenses and credited to reserves. Equity reserves is created, equity ESOP reserves, and thereafter for vesting, for lapse of ESOPs, all the entries will be passed in those reserves. And it will not be remeasured every year. Normally who deals with Indians, they know that every year few things are remeasured. In this case, it will not be remeasured. It will be amortized over the period based on Black and Scholl. But in case of cash settled, it is booked as liability. It is debited to P&L as employee expenses, but it is booked as liability. And since in cash settled, notionally the valuation is just every year on various factors. So at that time, it is remeasured every year and the difference is adjusted in liability or expenses as the case may be. Accounting part is, I think, we can skip. One more thing, that in case of ESOPs which are issued, so there will be dilution. So in case, while EPS reporting, you have to consider those ESOPs and report dilutive EPS as well, where cash settled SAR is there will not be any dilution. Now, very interesting and famous case law which is just recently has been prevalent. Though the facts we might be knowing or we would have read it, that Flipkart Limited is a very good company. Walmart has taken over, etc. Valuation of 16 to 20 billion. So Flipkart was having phone pay business in the company itself earlier. And Flipkart has formulated an ESOP scheme in 2012 and has granted a lot of ESOPs to various employees. So, but recently, before 2 to 3 years, they divested their phone pay business in separate company, and which was also valued around 5-6 billion. So the valuation of Flipkart went down from 16 billion to 10 billion. So of course the employee who were working for Flipkart, they were working for the entire Flipkart. And now the valuation of suddenly their rights of ESOPs has come down drastically, 50, 60, 70%. So management thought it fit that for reduction in diminution in this ESOP value, let us compensate the employees. And they decided to compensate employee at certain rate per some dollars per share. So now the employees, Sanjay Baveja, took a stand that this receipt is not taxable as salary. Because he has not exercised his rights, so perquisite has not arisen. He is still holding everything, and whatever he has received is a capital receipt not subject to tax. Department is arguing that it is nothing but salary, because whatever he has got, it is because of his employment and emanating from his employment contract, and therefore it should be taxable salary. So this is not an assessment, but employee had made application for nil deduction certificate, which was rejected, and then employee directly filed writ petition before Delhi High Court. But Delhi High Court ruled in favor of the assessee, saying that yes, there is no transfer of right because rights are intact. Under salary perquisite, only those cases will be covered where rights are exercised. That stage has not come, nothing exercised, so salary is not covering. Secondly, there is no transfer of rights as well, because no rights are transferred by employee. It is voluntary payment by the employer. And nowhere in the contract or ESOPs it is written that the employer has to make this payment. And therefore, High Court ruled that this transaction is capital receipt, not subject to tax, and department should grant the nil deduction certificate to the employee or person Sanjay Baveja. Very good judgment for employee. I doubt where it will settle. Just after that, my feelings with the Madras person who is residing in Tamil Nadu. There, Madras High Court has exactly called opposite. No, it is a salary, similar facts, same facts, but they hold that it is a salary ultimately. Here department was arguing, department was not taken even a plea that it is a salary. Department is just saying that there is some right. There was a right to sue or specific performance employed because of this reduction in the valuation had right to sue, and which he has waived now, and therefore it is a capital receipt subject to capital gain tax. Department has not taken plea of salary at all. Assess's contention, assessee was mainly relying on the Delhi High Court judgment and all the propositions that it is rights are same, not transfer, etc. So not taxable. But Madras High Court, single judge bench has taken a view that no, it is a taxable because ultimately what he is getting is because of his employment contract plus the definition of 17 to you see it starts with perquisite includes. So he referred that definition is inclusive definition, so it is wide enough. And secondly, about shares, perquisite 17 to 6 specifies that when shares are issued at price lower than the market value, then it should be taxed. So he said it is wide enough to cover this transaction, and therefore department was right in not granting TDS certificate. So confusion. Now if we say tiebreaker, then another High Court judgment, Karnataka High Court in favor of assessee following Delhi High Court judgment, and they distinguished various propositions which were upheld by Madras High Court, that no, what Madras High Court has evaluated or concluded is not proper, and Delhi High Court judgment should be followed, and ultimately this is not taxable receipt and nil deduction certificate should be granted. So if we say tie break, then right now the matter is in favor of assessee. Now some more controversies. So what happens if during vesting period person has worked in India but has become non-resident when it is exercised? See, I'll give you an example. Somebody who has worked in India till 2018 and then he shifts to UAE and his exercise options in 2020 in UAE when he is non-resident. So whether salary will still be taxable in India or it will not be taxable, because when we say accrue or arise in India, so during vesting period partly services were rendered in India or not rendered. Sometimes it is not clear whether services rendered in India for what period he is here. But the question is, if he is non-resident and at the time of exercise, whether it will be taxable or not. So very interesting case. Here tribunal, Mumbai Tribunal Vice President Pramod Kumar has written a very good judgment. He has interpreted that when shares options are granted, so that has to be considered. We all along we were saying that vesting period is important, this is important, exercise date is important. But in this case, he has interpreted that when employees are granted ESOPs, on that date, till that time, whatever service is provided, he is granted ESOPs for those earlier services. So important is not from grant date to vesting date, what you are where service is provided. Important is when stocks, ESOPs are granted, till that time where you have provided services. So in this Unikrishnan case, this HDFC bank person, up to 2007, he had provided services in India. In 2007-8, he shifted to UAE. He exercised option somewhere in 2009. So he said that I am non-resident. So at the time of exercise, I am not. The income is not accrue or arise in India. It is not taxable. And alternatively, he had taken protection from DTW. That employment is not exercised in India, and therefore it is not taxable. But both his argument, first of all, what he thought, assessee, and I think I will be with him on this, that he has taken argument that from the grant date to vesting date, since I was not in India, it should not be taxable because services are not rendered in India. But what tribunal has taken a view that options are granted because of your earlier service. When on the grant date you are eligible for a certain number of shares ESOP, so those services we have to see. And based on that, they argue that it is taxable in India because at that time he was in India. Secondly, DTW protection, UAE says that it is to be taxed where the employment is exercised. So that also he failed because employment was exercised before grant date was in India. So in both he was rejected and it was held that it is taxable in India. In Anil Bansali's case, this person had, I think Microsoft person had, during the vesting period, he has provided some services in India and partly outside India. So what he did was around 1.5 crore, 50 lakhs, he didn't offer because he taken a plea that these services were rendered outside India. In this case, Hyderabad Tribunal upheld that yes, for services which are rendered outside India when he was not resident, to that extent it is cannot be brought to tax in India. One interesting case here, sale of right, ESOPs are rights, right? Not an obligation. And if you redeem that or you waive that or you surrender that just before the exercise date, then what will happen? So in some of the Delhi Tribunal judgment, there are 2 to 3 judgments, when it is said that those rights which are surrendered and the proceeds are given to employees out of sale of those shares. So he has surrendered rights, company has sold those shares and then given him proceeds. So it is again surrender of right and it is not, so then it is a capital gain and the holding period will be considered from the grant date. In this case it is before 2000 period was applicable where taxation of perquisite was not clear, it was governed by circular etc. So not very well drafted judgment or not, various facts were not very clear, nobody was taking plea of salary etc. But ultimately it was held that holding period starts from the grant date and if it is ESOPs are surrendered before the exercise, then it is a capital gain. But at that time these provisions were not there, so I doubt whether this will be applicable now or not. Conversely to first case, if some person has services rendered outside India all the years and just on the date of exercise he is resident in India, then what will happen? So if unique rational case was in favor of India, then this will be against that since entire services are rendered outside India, so when the exercise is only done in India, it is not taxable. Now ESOP schemes also gives rights to various consultant professionals or even the vendors. So there of course salary provisions will not be applicable, but taxation would be more or less would be similar to the taxation what we have discussed for the salary. Now what happens if somebody who has given services and shares are maybe vested, not vested and expires? So under Companies Act, Rule 12, Share Capital Debenture Rules, it is specifically written that if some employees died before vesting, then those shares will be automatically vested. Even before completing of the vesting period, those shares will vest in the legal heirs of the employee. That it is written. But now, what about salary taxation? The exercise will be done by legal heirs, who is not employee of the company. So I think one can take an argument that there is no employer-employee relationship. Earlier what we discussed was, in a way, employee was getting salary from employer, but here it is completely different case. Legal heirs are not employee of the company. So therefore, one can take an argument that it is not salary taxable, and if somebody will say it is without consideration and it is other sources 56 to 10, then one can take argument that it is nothing but inheritance from the person who has died, and therefore not taxable. I tried to find some judgment on these aspects, but I didn't get. But we have seen this practical difficulty. We have taken a view that it is not taxable. Last is if sometimes individual promoters give some shares to employees in connection with employment, directly or through a trust, where trust is created and then employees are granted some shares based on some conditions, whether it can be said to be salary or not salary. See, one take a proposition that it is not salary because I have not received from employer, then it will be definitely taxable in 56 to 10 because it is without consideration. And if say no, it is against consideration of my giving services or rendering services, then it will be taxable as salary. So difficult proposition. This transaction ultimately should be taxed as a salary towards employment.
When the company allows shares to consultant or a vendor, whether 56 to 10 will arise or not?
In the hands of
Consultant or a vendor?
Yeah, it should tax. So according to me, if it is against profession or business, it should be taxable under that head. Mechanism can be followed as what is prescribed for 17(2)(6). Specifically, there are no provisions under business and profession. But if you are getting against your normal dues, then it's okay. But if it's over and above your dues, you are getting this, then yes, 56 to 10 will apply.
But 56 to 10 says the value as per Rule 11 UA.
Yeah,
Which
yeah.
is around book value.
Yeah,
So
yeah.
company startup,
Yeah,
the book value is around
very small, very small.
So it is at book value or we need to get valuation done?
So according to me, it should be proper valuation. So if suppose for employee you are taxing at certain rate, so reports are already on record, and then you offer at lower rate, it's not proper. So with this I complete my presentation. Any questions we can take up. Right now I don't know what time is there, so we can take offline as well. Thank you.
Thank you, Chintan, for such a wonderful session. We can have one or two questions. I think there's no questions from the audience because they have understood the topic. And I request Vijay to propose a wellness ordinance.
Thank you, sir. I think all questions are already answered during the session, so now no more questions left. So you all agree that Esop is just the 4 alphabet, but it's regulated by so many laws and regulations. So the way Chintan sir has taken us through, it was difficult to remember everything. So we are definitely going to come back to you for the queries in future. So I agree that you all will agree with me with the insightful presentation on this Esop taxation. With the expertise and clarity, he has explained the entire Esop taxation in quite a detailed manner. So we appreciate your engagement and efforts and answering all the queries raised by the members during the session. I, on behalf of BCIC, would like everyone to please join me for a great applause to the sir for the wonderful presentation. Thank you so much. We are concluding for the day.